trying to say my voice, I'm a little scratchy. Access, I already quietly. Access to this webinar is for educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trade. All securities and orders discussed to track the monitoring virtual trading accounts, virtual account prices, and the terms may differ from actual trading results. Commission costs are excluded. NeedAffiliateStockWorld.com, PSW, nor its affiliates or any of their respective officers, personnel, or representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services are meant to teach you the risks and potential rewards of trading options. And we are not a service that tells you what to trade with, not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold about harmless. Many losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured we take your privacy very seriously, and we will not distribute or sell your information to anyone. Yay! All right, we got to do that. How are we doing? People there? Fantastic. Ow! Let's see. What do you think about Apple 100 now? China impact. Forgot to mute you people. Hang on.
You are now muted.
There you go. Now I have it. Now I have it to myself. Now I have complete control. All right. What do we think about Apple 100? We like Apple 100. Is the China impact overblown? China impact on Apple? The thing about Apple is that they are too big. See if I have my regular, yeah, oh, here you go, look. Apple is a $560 billion company at $100. So if they go to 120, they will be a $670 billion company. So first of all, for them to get to back to 120, $110 billion of market cap has to reappear. How do you justify $110 billion worth of market cap? Well, you kind of have to sell. You have to make $10 billion in profit. So to make $10 billion in profit, let's see what Apple's doing. They're currently doing $200 billion in sales, and they convert 20% of that, which is fantastic, into profit. 25% of that into profit. So for Apple to make $10 billion, they have to come up with $40 billion more in sales. So that's, I mean, you know, when you look at the company, that's what you have to look at. You have to say, well, how much are they making now? And how much do they drop to the bottom line? And therefore, if I expect them to go 20% more at the same valuation, you're assuming sentiment doesn't change in the stock, what would Apple have to do internally to make that happen for you? Well, from here, Apple's got to, they've got to basically drop another $10 billion to the bottom line to justify another $100 million valuation. So that's at 11 PE. I'm not arguing, you know, there's a different argument whether or not the PE is too low or whatever. I'm just saying, if you look at it steady. So the thing is, when you're that big, here's the problem, right? Even though they have fantastic margins and all that, still, what are you going to do exactly that's going to get people a, what's going to get you the next $50 billion thing to sell that's going to make $10 billion in profit? They're already selling iPhones and iPads and iPods and blah, 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 blah. That doesn't count. You can't say, oh, because it's not likely that iPhone sales are going to expand. Or they might expand, but like the iPods, they get cheaper while they expand. So they end up bringing in the same amount of revenue. So there'll be more iPhones out there, but they're cheaper iPhones, and they'll end up just generating, Apple will have a bigger market share, but not necessarily more revenue. It's something new needs to come along the line, so to make them $50 billion. $50 billion is, excuse me, $50 billion is Amazon's entire sales. Okay? AMZN, this is what a joke Amazon is for valuation. I'm sorry, $100 billion. Or $88 billion. So Amazon's entire sales for the year, $88 billion. This year will be about $100 billion. And you think it's easy for Apple to add $50 billion in sales in what, a year, in a quarter? When are you expecting 120? Apple is too big to succeed at this point. Okay, they're so big, their market cap is so large that unless they come out with something unbelievable to add to their services, they can't grow. And at this point, it's kind of a problem because really, if they want to grow any further, they do have to buy something like Beats, like buying headphones. They have to buy stuff that they can add on to their product lines that will expand what they do. Even their retail store has a problem because their retail store is the most successful retail store on the planet. They sell more money per square foot than any other store in the world by by more than double. Their numbers on their retail space is incredible. But that's the problem because then you say, well, how are you going to improve on that? You can't just infinitely improve things. When you do something really, really, really well, you kind of hit the top. Let's say Apple is shooting the free throws, right, in basketball, and they shoot 10. Like every company gets to try to make 10 attempts. Well, Apple is 9 out of 10. And that's where their valuation is reflecting that they're 9 out of 10. They're the most valuable company on earth because they can hit 9 out of 10 free throws. Now, the thing is, though, if you're investing in Apple, how are they going to improve? There's only 10 possible throws they can make. So you can bet that they'll get 10 out of 10. You can bet they'll be perfect and completely perfect, but how are they going to be better than perfect? This is almost a perfect company making almost perfect amounts of money. I mean, geez, you just... You have to understand, look at this, $88 billion, no profit at all. That's Amazon. Okay? And then you go to Apple, and they do, well, this is quarterly, hang on, they do $233 billion. They make as much money as Amazon does in sales. That's almost 25% net profit after taxes. That's insane. This is a perfect company running on all cylinders, doing everything they possibly can do correctly, and they're growing sales. So look, I like Apple. I like them as a company. When they get cheap, I want to buy them. But as we discussed in chat today, it's like I like selling the 2018 $95 puts for $15 or $14 today. But I like selling 2018 $95 puts for $14 because that nets me into 86. So I don't need Apple to grow to make money on my short $95 put. I just need them not to go lower. And I make 100%. So if I can make 100% in 2 years doing that, why would I bother? Why would I tie up a ton of money into Apple and try to hope they go up when going up is hard? Going up is really, really hard. It's a lot of money. Making 10 billion sales. There's maybe only 20 companies on the planet that make $10 billion in annual profit. They make $50 billion, and they're heading to $60 billion in a year or so. In 2 years, they'll be dropping $60 billion to the bottom line. But where is 70 going to come from? Where is that next 10 going to come from? What are they going to do? So unless you see an actual brand new Apple product that doesn't cannibalize their old products, that's capable of generating a tremendous amount of cash, and Apple TV is not, that's when you're going to do it. Because look at Netflix, for example. Okay, let's say Apple TV is a complete success and they do as well as Netflix. That's only $5 billion in revenue, no profit. That's why Apple doesn't push the TV, because there's no money in it for them. They don't. Why would they even bother making an effort to make $260 million? It's not even worth. It's not worth the time of the executive staff they would have to allocate to the process. Their guys make 20. Their guys drop 20% to the bottom line. So if you're an Apple executive and you have a $5 billion project that you're in charge of, and you're not making $1 billion, you're going to get fired. So you can't go into a division where your whole plan is to make $200 million on $5 billion. That's crazy. That's never going to work. That's why Apple doesn't buy other companies, and that's why Apple doesn't go into a lot of new things, because they only go into things that make a lot of money. You know, which I like. I like his philosophy. I like their strategy. It's a good, steady thing to have. So I like them long term, but I don't expect them to go. I'm not buying them at this point expecting Apple to go jumping higher. I only buy Apple to expect them to steadily grind out $50 billion a year for me. And for that, I don't mind giving them $600 billion. But that's my bet accordingly when you're going into Apple. All right, let's see what else is going on in the market. Oh, ugly. Well, fortunately, we did an alert, and I just said it. We were just in chat. Where was I saying it? This is today's chat. I just put up a warning saying to stop out of these things. You know, we had all these bullish calls in the Morning Post. We should talk about that and like why we do this. Oh, here you go. So I called it at 11:50 right after Europe closed, and we were at 875 and 1990. So where are we now? And yep, that was a pretty good call actually, because we just see. So here's me making the call where we're right up here. Let's go to a shorter term window. All right. So here's where we went long in the morning. You know, up into 8:15. Then we started going up. Then here, right here, when we started bottom, you know, as soon as we started curling over. Okay, we tested, and so at this point I sent out a note to everybody saying have tight stops here because it doesn't look good. And that's what happened, and down we go. Boom, boom, boom. We could have actually shorted at that spot. I also said, like an idiot, I said we should have got that. I said I should get out of my natural gas play, but I was busy on the phone talking to some people about stuff. I didn't, so $12,000 down the drain because I didn't get out of my natural gas play. Like I should have. But I knew it when it broke that 240 line. I was like, damn, we should get out of this thing. Not that it won't come back, you know, but why should I take them? See, the thing is, why take the loss? I knew it was going to pull back. You know, so why take the $12,000 loss? I could have taken that. I could have taken it off the table there with my $60,000 and then started building my position back up here. And instead of taking the loss, I would have had a better net basis. That's the correct way to play it. I know the correct way to play it. I just didn't play it because I was busy. But that is the correct way to play it. We were looking at the S&P here. Well, it's a little higher now. So we wouldn't go back to play the S&P because it's higher than it was this morning. We wouldn't go back to play the Russell because it's higher than it was this morning. We would go to play the Nikkei because it's right where it was this morning. Okay, that's good. So now let's look at the Dow. YM. Let's look at other things we can play. The Dow, higher than it was this morning. Not really something I want to play. I like the 1090 line on the Russell. I want to keep it. I don't care about the Dow, so I'm going to get rid of it. Let's look at silver is another thing we were looking at this morning. Is it 14? Silver's under 14. I like that for long, but now I want to know where gold is. So where is gold? Gold is up, silver's there, I'm going long on silver. So here's an easy, see, I'm poking around for things to buy, but now I want to know where the dollar is. Okay, so now that I'm switching to metals, I'm going to start watching different things. I want to see where my dollar is. Dollar's rejected at 99.50. I like it, so I have no reason not to hit the buy here. And I'll add a silver contract. So that's 13,975. If we're lucky, we'll catch a spike up to 14.10. 10 pennies on silver is, I think, 500. I think it's $50 a penny on silver. So if we get it to 14.10, we'll make $500. All right, so that's a trade to make it worth your while to sit around and listen to me yammer on. If we make $500 while I'm talking, I like it as long as gold keeps going up, as long as the dollar doesn't go up, as long as the dollar keeps going down and gold keeps going up. I have no reason to think silver is going to trash out. I'm also keeping my eye on the Nikkei. I still would like to make that play, but only off the 1800 line. Really don't want to. I don't want to catch it while it's in the air. You know, I want to catch it when it hits the ground. So I'm waiting to see how it does around this line. But if you know, right now I'm just expecting everything to sort of come up a little bit into the afternoon. I do think we're bottoming out. I think this is the end of the sell-off. We haven't had, other than the August crash, we haven't been allowed to have more than a 5% correction all year. And so this is a 5% correction. So if you're being bearish, what you're really doing is you're betting the central banks don't have the ability to support the market anymore. That's what you're betting on. And I bet they're coming to the end of their ability to support the market. I think it's harder to support the market, but I don't think they're done yet. I still think they can do it. So we'll see what happens. All right, but all I did was I cycled through my favorite trades. So this morning we discussed all of these trades, the Dow, the S&P, the Russell, the Nikkei, gold, silver. We talked about all these trades in the morning. Oil I don't care about, by the way, because it's not something I would go long after that really awful inventory report. I wouldn't go long on gold, which is now under 34, in fact. And by the way, gold is what's dragging natural gas down. If natural gas was going down for its own reasons, I would have gotten out immediately. I would have dropped the phone, not had my meeting that I was talking to people on or whatever. But you know, this just wasn't important to trade it, because the only reason that natural gas is being dragged down is because of oil. Oil is dragging natural gas down. On its own, once oil stops going down, natural gas will float back up again. It's just a question of whether I want to be bothered actively trading the ups and downs on the thing. All right, so there you go. There's a quick $50 in silver. But like I said, as long as gold is up here until it's rejected, if it is rejected, I'm liking that trade. So if gold can punch up a little bit higher, especially if gold makes a new high for the day, you know, people look at this. They're like, well, if gold's made back at the high of the day, why is silver down here? What the hell happened? Why isn't silver back at its high of the day? And there's no particularly good reason for that. So we'll see how that goes. So that's our first futures trade that we're putting on. We'll see how some others are. Look at the overall chart. The index is not looking pretty, but they are they are holding up. They're better than they were this morning. They're holding up because they are, you know, because they're managing to hold the 5% line. That's what I expect them to do. I want them to hold the 5% line. Oh, freaking Netflix! Look at that. Our goal was 105. We were right down at 105. It already popped all the way back to 115 and then got rejected. 105 is where we wanted to be. That's annoying. All right, what else? Message, questions. Why bid is going down so much? We bought it around 34 and now it's 24. Yeah, bid is pathetic. Why? Bid had a huge auction that they put off. It didn't go as well as they thought it would go. But even worse is they put off the recognition of the auction until next quarter. Even, you know, so the earnings are coming up in January or February, whatever they have their earnings, they will not reflect all the money that they took in will not be reflected. So I imagine that now on bid, let me take a quick look over here. I want to see if estimates will come down. Yeah, estimates for this quarter have dropped from $1.36 a share to 90 cents a share. That's a big drop. So that's where your drop comes from. That's what is that? 40 to 136 is like 33%. So that's about how far they drop. But that's the thing, though. The earnings for next year, for 2016, are still about the same. They were 267, now they're 225. And we're talking 225 for a $23 share of stock. You know, this is not a company that should have a PE down around 10. All right, so it's a good buy. It's a good long-term position to be in. It's just not turning around as fast as we hoped it would. So unfortunately, we're just riding it out now for the longer term. I do like them a lot. I think they're way underpriced here. They had a messed up auction. They had to move some stuff around the shuffle deck chairs, but expectations are way too low. And I think we'll see that when the earnings come around. The company's not in trouble. It's not a problem. It's just a matter of the way they're recognizing revenues this year. Let me see quarterly what they look like. Yeah, hang on. Let's see if we can find this. Hang on. So this is a quarterly. Let's look at annual. And they're always going to be uneven because they have auctions at different times of the year, so their earnings are always going to be weird. But see how they go 7, 850, 950, whatever, right? And you go 108, 130, 117. That's 117 million. It's only a $1.5 billion company, so we're not asking for the moon here. All right, so $117 million for a $105 billion company. Now, quarterly. Oh, I'm sorry, I lost track of what the annual was. All right, almost $1 billion in revenues. Okay, so quarterly, what have they done? 155 and 320 is like, excuse me, 480. And here's where they ditched the auction. This is what makes it all look terrible. So it's 480, but still 580, 600,000. So they're still, if they pull in 250 this quarter, they're still going to be up around where they were last year. All right, and last year, where did they trade at? Last year they traded in the 40s. High 30s, low 40s, right? So they're no worse off than they were last year. They had they took a loss over here in this quarter, but money-wise, they're looking at 67, let's call that 50. Here's 55. That's only 2 quarters, or I'm sorry, 3 quarters, 55 and 3 quarters. So let's split the difference and say 25. So let's say they make 80-something, they drop to the bottom line. Last year, they did 117. So they're going to do less than last year, but not terribly less. And going forward, no one's expecting them to do worse. And the whole reason for it, though, it's not that the money disappeared. It's that they took $30 million. The $30 million they're short. That money is because they didn't recognize the revenues of an auction because technically the auction isn't complete, and they chose not to recognize the revenues in 2015. They won't recognize them until 2016. That's what it's all about. And people, it's like Taser. It's like because of the way they're recognizing their revenues, not the lack of sales and not the lack of profits, but just because of the way they're recognizing their revenues, an accounting issue, basically. People, and not a bad, and not even negative accounting issue, just an accounting choice that they're making. Everybody's bailing and freaking out. So, look, that's what an opportunity is. Or you have to look at something differently than somebody else and say, I see that not as a negative. And every time you buy anything, you always, it's not just the stock. Like if you buy a house, right? You're buying a house because you perceive value in the house. There's somebody, but when you're buying a house, there's a guy standing right in front of you who's selling it. He values your cash more than his house. for whatever reason, right? And as you know, there are other reasons at play. It's not just whether or not he wants to live there. It's whether he wants to live there, whether his family needs a house that big, whether it fits his overall portfolio of investments, whether it fits his current lifestyle, whether he feels that the area is going to appreciate, what other investments he has, how they're performing, how much cash he needs, so on. There's a million factors into why somebody values something differently than somebody else. That's the same when you're buying a stock from somebody as when you're buying a house from somebody or a car or whatever. You just don't tend to think of it the same way. But everybody's doing the same thing. They're valuing something for certain reasons. So the funds that had bid for a certain reason, stability for one thing, expected them they wanted management to focus on growing revenues and profits every year steadily. Management said, no, we're going to focus on running our auctions properly. So management said, we don't care about profits. It's a terrible thing to say when you're management. But they said, we don't care about the profits. And they don't mean they don't care about profit. They mean they don't care about how profits look on the books in any particular quarter. What they said is, we have this auction, and we choose to space it out over such a time and recognize the revenues over such a time that it makes sense for us to manage it that way. And that caused a lot of people to bail out because a lot of investors had no patience or they don't want to see anything different happen. You know, and Yahoo's getting that way too. Yahoo's getting very cheap because people just don't like what they're doing. I don't like what they're doing, so I wouldn't be buying them right now. But I think they're interesting getting down here. Get down back around 25. I'm going to be very interested in Yahoo. Because, you know, their cash and their holdings and all that, they're worth, if you break them apart, they're worth more than that. And they get to the point where they are going to be broken apart because nobody can think of what to do with them. Any interest in AXP? I like, what is this random number? I don't know what that is. Okay, AXP. American Express, they lost Costco, big account. And that hurt them this year. They also, they haven't done, you know, look, they never really got a handle on how to service mid-range customers or obviously low-end customers. And now everybody goes after the high-end customers that American Express used to cater to. And frankly, some of them do a better job. I mean, I happen to be a Centurion card member. I mean, yes, there are certain things I don't think I would ever walk away from with American Express. I get such fantastic upgrades on airlines, hotels, things like that. But on the other hand, though, I get pissed off because I get these concerts my kids want to go to. They're only for Visa Black people or whatever it is, you know, Visa Golds or whatever they are, special events, and MasterCard special events and stuff like that. And these are things American Express used to do more of that they don't do anymore because they cut back on their services. And I think to some extent, obviously, it's because it's like with Netflix, like everybody's competing for the content, right? There's only so many Masters tournaments, and there's only so many food tasting things in Aspen to go to. So it becomes more and more expensive for each of these credit card companies to bid to be the exclusive sponsors and to have special things put aside. Damn it, now I'm getting caught. So anyway, so I don't see that American Express is going to snap back. The company you see here is not the company that exists over here. Costco alone was probably 10% of their business. So take that out right here. So let's say last year they averaged like 85. So now 75 would be the top they should be anyway. And where are they? They're at 65. So, you gotta look at the chart and realize they're not coming back to here. This isn't their goal. Their goal is to get back to 75. And frankly, they haven't been executing well enough to expect that to happen anytime soon. So I like American Express. They're a good blue chip company. I think long term they'll put it together, I would think. But as a top level customer, the kind of person they cater to, they really have. I mean, after God knows how many years, I must have been a black member for like 30 years now. I can't imagine how they let that slip so far. Used to be the best service in the world, and now it's like good, not great. I wouldn't even call it great. I'd say it's now good. I think that if I didn't have the habit of using them all the time, I don't see where it'd be. I don't know that I would jump in and try to become a new member. There's certainly nothing in there compared to what other guys offer in their top programs that I would jump to American Express for. And in fact, frankly, in PSW Investments, we have an investment company. In PSW Investments, I've been considering setting up a premium service, setting up an experienced services company because American Express is so bad. I talked to some people about this, where we said, we could replicate these services. You don't have to have a credit card to have a program where you give people fine hotels and upgrades and dining specials and things like that, and have reserved hotels and tables around the world. There's ways to put this together in a clubby sort of thing without even, the being an American Express thing, that just gave them a marketing database to use to sell that program. But the program has nothing to do with them being a credit card. And nobody, I've used the MasterCard one, they don't run it well. Nobody runs it well. It's just sort of something they all feel they have to do, and they've all got their own events. But, if somebody just ran that as an actual business, I think it could be a huge business. So if anyone happens to be in that business or knows it, definitely get in touch with me, because it's something we're considering. It's all a matter of, how much money it's going to cost to set it up and so on and so forth. But that's my point on American Express, though, is that they don't offer anything that unique anymore. So they're just a credit card, and I don't think they're justifying the valuation, or they don't justify a higher valuation than anybody else does. But again, down here at 65, if they got down to like 55, I'd be very excited about just owning them long term, because they are worth it as a basic credit card company. That's a good price. As an investment at 65, it's not exciting to me. Let's see how things are going in the market. Wait, what's any other questions here? American Express rate. All right, see, we're holding on, so that's good. Oh, silver. I knew there was something I wanted to look at. Damn it. You guys got to remind me when I have money on something. Not going anywhere. Gold's still okay, though, so we'll see what happens. All right, I'm willing to hold on to that and see what happens. How's it? The dollar is creeping up. We don't like that. Here's the Nikkei. He's doing okay. Take a look at some of the other things. Natural gas coming back a little bit. We'll see what happens. Gasoline, yuck, holy cow. 116, that's so funny. Amazon way down, Netflix holding on, Tesla not so good, Apple holding on to 100. We triggered that Apple thing today, so that's a big deal. We called it, we're basically putting our foot down on Apple down there. Okay, all going along fine. My take on Apple is that they're so large now that that I don't expect anything exciting from them, but I do like them at about 100. I expect them to be about 120 or more in 2018. So if you want a nice steady thing, the thing is, see, the way we play options, we don't need them to go up. We just need them not to go down, because we can use spreads and selling short puts and things like that. So we can make 100% if they just hold 100. So that's what so it's a different kind of view on it. Like I wouldn't buy Apple stock for 100. I wouldn't tie up $100 to buy Apple, because I don't think they're going to make enough money on my $100 to make it worthwhile. They don't pay enough dividend to make it worth tying up $100. But would I sell the 2018 $95 puts? Hang on, let's see what there's a price at. So if I sell the $95 puts for $14, and I take that $14, and now I'm going to sell these for $16. Now, if I'm selling for $16, it means I can buy something for $30. So I could buy the $75 calls for, well, this says $32, but that's the last sale. I would buy these for something in between $30 and $31.20. So that's like $30.60. Let's call it $30.75, and I would sell these for $14.50. So that's whatever that is. It's $16.25. So this spread would be $16.25. I'm sorry, it's a 105. Silly me. My mistake. Sorry. This is $16.85, and damn it, let's call this 17 just so I can stop messing around. This is 17 and this is 31, so let's call that $14 for the spread. Obviously try to do better than that, but this is $14 for the spread. So I take that spread for 14, I sell these calls for 14, these puts for 14. My net cost is 0 on the Apple 2018 75 100 spread. All Apple has to do is hold 100, and you make $25. All right? That's 25% of the full price of Apple. And all Apple has to do is not go lower. Now you have the 95 puts, and if we look at Thinkorswim, and we say we're going to sell, let's say I sell 10 95 puts, and I sell them for $14. It tells me that only cost me $8,500 in margin. So I need $8,500 in margin to sell the puts, and then I need the $14,000 in cash to buy the bull call spread. My net cash outlay is 0, and I got the $8,500 in margin because I go after the $14,000 cash for selling these puts also. So it's a nice place, margin efficient, and you're going to get back, if all goes well, if all Apple has to do is hold 100, you get back $25,000 on 10 contracts. What's your worst case? Your worst case is if Apple is below 95, you'll be assigned 100 shares of Apple at net 95. So it'll be 95,000. You're risking owning $95,000 worth of Apple stock. Your upside is $25,000 if Apple just holds 100. And since you have the $75 calls, Apple would have to be below 85 before we start losing money. So that's what I mean by the option trades. Now, when I look at Apple, I can start putting my foot down here, because even though it might go lower, I really don't think it's going to go below 85, and that's my break even. So I can establish a position here, and if it does go down to 85 or 80, I'm happy to double down my position and roll it, and then I'll be buying 2,000 shares of Apple for a net of like 80 or something like that. And I just can't see why I wouldn't want to do that. I cannot imagine how in the next 2 years I'm going to say, oh no, Apple isn't worth $80 a share. So that's why at 100, even though I think it could go to 80 at 100, I'm willing to start making some put some positions on the table. Yep, exactly what Sam says. Good job. Stan, would you please discuss your preference for bull call spreads? Is that what you're saying? Instead of risk reversals? What's a risk reversal? I'm not sure what that is. I mean, are you saying, I honestly don't understand what you mean by that. I think you're saying bull call spread, but maybe I'm wrong about what you're saying bull call spread. All right, because I'm not sure what the definition of a risk reversal would be in terms of a play. Are you still excited about Disney? I'm not excited about, I'm a lot less excited about Disney than I was. Holy crap. That's sad. But again, it goes back to, it's like, yeah, I'm excited about Disney because I think that the fears are overblown. I think you're looking at a company that's very likely to put up some big numbers. All right, see, unlike Apple, Disney is only a $165 billion company. Disney has $50 billion. So the amount of money, the amount of revenues that Apple needs to generate are Disney. So Apple needs to grow by one Disney to make 10% next year. Just to put that in context, because here's a great example. Here's a company that is doing $52 billion in revenues. They are dropping $8 billion to the bottom line, and they are worth exactly, they're worth the $165 billion that you want Apple to gain to get to 120. So for Apple to get to 120, they have to add one Disney. Took Disney, what, like 40 years to get here. You want Apple to be, people expect Apple to do that in 2 years. That's why it gets unrealistic when a company gets so large that you're like, it has to build and grow an entire Disney in 2 years to make 20% more money. How likely is that? If they were that good, they should go work for, if there's a guy at Apple who's that good, he should go work at Disney and double their stock. Why waste your time getting 20% more in Apple? You should be that. And that's what happens is that people leave, people in divisions and people who are executives. They're like, well, how can I have an effect? And, when you're an executive, you make those decisions. You're like, well, how am I going to really impact the company? When you're a top-notch guy making millions of dollars a year as a chief executive or a high-level executive, you think about that when you're going to work for a company. You're like, how can I impact that company? They offered me a job, a title company, Lawyers Title, was going bankrupt in 2008, and they asked me if I wanted to take it over. And I was looking at the company saying I could probably save it, but it's still going to be a disaster. So if you want to save the company, it was a good job. They're going to pay me a nice amount of money. I'd have to live in Virginia, which did not appeal to me, frankly. Not the good part of Virginia, like the middle of it somewhere. It would be a big change for my family, so there are reasons I didn't do it. It would have been fun and challenging, but I looked at the job and said, you know what, I think there's no out for me, though. All I could do is sort of stop it from going bankrupt and get it into good enough shape to be sold, and I'd make a few $1 million over a couple of years, but the amount of work that would have to be done and the change in direction of my life, like giving up everything else I was working on at the time, it didn't work out. It wasn't worth it. So those are considerations you end up making when you're taking jobs like this. You say, what kind of impact can I really have, and what is it going to be as far as how is it going to further my career? How's it going to look on my resume, so on and so forth. So when a company gets so big like Apple that all you're going to do is be just another cog in the machine, and Google's like that too now. It's like, you're not really sure how you're going to fit in anymore. You're not growing some great big company. You're not really part of Google. In fact, even Google, that's why this is alphabet nonsense. They're trying to build divisions because they understand that. If they want to get the best and brightest people, which Google is very, very focused on, but if you want to get the best and brightest people, you've got to offer them more than money. you've got to offer them a way to make an impact and to make a difference and to have a real something that's theirs that they put their name on. Otherwise, you're not going to get the best people. The best people who go somewhere else where they're going to make more of a difference. And like I said, if you're a guy in Apple who knows how to build a $50 billion company from scratch in 2 years to get those extra revenues that Apple needs, then what the frick would you stay at Apple for? You got to get out of there and go do that somewhere else. Because if you do it for Apple, all you're going to get is a pat on the back and a little bit of a raise. If you do it somewhere else, you'll be considered one of the greatest CEOs in America. So, so Disney, by the way, has Bob Iger, who is a great CEO. What? I hate that one thing. All right, let's try that again. Income statements. There we go. So, pretty slow, steady growth. It's not an exciting industry that they're in. They're in the media. But he has been, he's been really doing a good job of cost cutting. But the problem is he's done a lot of this cost cutting already. And the thing is, though, that they didn't have any bombs this year. So we have $8.3 billion last year. You're looking at revenues of coming in at 2652. So the revenues are not really better than last year. Earnings are looking like, let's call it $8 billion. Earnings aren't better than last year either. So this is pretty flat to last year. This year. The question is what happens next year? And that's what you got to look ahead to. So now if we look at the estimates for next year, they do have a decent pop. Oh, this is already we're into next year. So they go from 515. They're going up 10%, and then they go up another 10% over the next 2 years. That's a nice pop. That's going to take them from $8 billion to $9 billion to $10 billion. $10 billion, when they're being valued at $165 billion, is a very nice P of about 16, and there it is, 4 P, once is 16. So you have a company that has a 20 P now that's dropping to 16, and if you look at comps like, I forget what these guys are. Let's take a look at Viacom for comps. They're at 17. They're dropping, well, according to that, they're dropping to 6. I would have to question that. Oh, no, their P is 9. So Disney's got a high P compared to Viacom. Fox, is it? Yeah, there's 2 Foxes. So you got Fox. Their P, oh, wow. I might have to change my mind on this. Fox A. Wow, their P is 11. Everybody's P is down to 11, so it's not that special. CBS can't tell, but it's down there. And let's look at Comcast, CMCSA. Comcast is high at 15. All right, so you know what? No big deal. Okay, so Disney is actually in-line valuation at 100. They're not low. But of course, everybody's gone down recently. That whole media space has gone down. And you look at the charts for where's the what happened here? Where did stock charts go? Well, there it is. So, everybody's sold off. It's not just Disney. It's this whole entertainment space that's been selling off. But everybody's dropped down to about this valuation. There's nothing especially low about Disney. I've been looking at them thinking they're being valued too low, but now everybody's being valued too low in the space. So at a certain point, you go, hey, that's just what they're going to value it at. So what was the question now? I forgot. So no, I'm not that excited about Disney, but I do think it's a very good value. Again, like Apple, I think to a certain point when you put your foot down and say, I want to be a long-term holder here. So I think that they're struggling from just an industry sell-off. In fact, if you look at this chart, compared to the other guys, they're actually holding up well compared to these other guys. They're only down 20%. They're 20% off their all-time high. Viacom was 80 and now they're 40. They're like 50% down. But the problem is because the whole media space is getting sucked lower, Disney's getting sucked down with it, and at the same time there's been a specific attack on Disney relating mostly to their ESPN revenues. Now, ESPN is a very big part of Disney. It's about 30% of their revenues. And the reason it is because they have a weird system where ESPN is considered basic cable, but Disney gets paid for it, unlike a lot of the other channels, or more so than the other channels. So essentially they're collecting like a premium rate, even though it's basic cable. So they get about $6 a month per user, but they get it from so many more users. Like let's say half the people in America have HBO. So let's say 50 million homes in America have HBO for $10 a month. Disney has 80% of the homes in America. They have 80 million homes at $6 a month. So they actually make as much or more than HBO for ESPN. In reality, if you unbundled ESPN from the cable, you might find that Disney's revenues go down to, if people, if I had to physically pay, I would obviously, because I like sports. Most guys would, but again, you'll probably get down to like that Time Warner thing where about half the people in the United States would end up subscribing to ESPN, and that would significantly cut down Disney's revenues, unless they could get $10 instead of $6. And that's something that the analysts don't take into account. Is it may be fine. Maybe they'll get less people, but they'll get less people at the same price as the other premium channels. So somewhere between a total disaster of dropping half of their subscribers in ESPN and being revenue neutral because they end up getting more money for the lower amount of subscribers, somewhere between there is the truth. Which means I don't think Disney is going to be as damaged as people think by its ESPN revenues trailing off. And I also don't think, I don't think anyone's taking into account the incredible amount of money that will be generated by Star Wars. I mean, they're looking at the box office numbers as if it's, comparable to Avatar at the moment. And they're saying, oh, okay, so Avatar made this much money for Fox or whatever. But that's not the story, because nobody's running around with Avatar figurines. Well, I'm sure somebody is, but nobody, not any kind of quantity. Star Wars. I was just in Disney on for my vacation just now. They've got whole shops that have been changed over to Star Wars, not just at Disney, at the airport too. I think there's like 100, 200 companies with Star Wars promotions going on. All that's licensing for Disney. Hasbro just had fantastic, fantastic revenues because they had the Star Wars toys. So they won the season because they've had incredible sales. It's all Star Wars toys. The merchandising numbers for Disney is going to be another $1 billion dropping to their bottom line, aside from the movie numbers. And then you've got to look forward in their projections. And like I said, Disney is only a company dropping $8 billion to the bottom line. So when they make another $1 billion, that's a lot of money. If Apple makes another $1 billion, they're like, is that a rounding error? Are you sure you carried the one? So for Apple to make $1 billion, nobody gives a crap. But Disney isn't Apple. Disney is a relatively small company, or let's call it a normal sized company. They're a normal sized big company versus Apple, which is a super giant colossus where the laws of physics tend to warp because they're so large. So with Disney, That matters. $1 billion matters. $800 million would matter to Disney. It'd be 10% of their bottom line. $400 million would matter to Disney because it's 5% of their bottom line. Okay, they just did $2 billion in ticket sales. They're going to go to $3 billion in ticket sales. They did the fastest $2 billion ever made by a movie ever by a factor of half the time of any other movie. So they're going to crank this thing up to $3 billion. Now, out of $3 billion, they're only going to physically collect back about $1 billion of it. Most of the money goes to the theaters and stuff. But let's say that they get back $1 billion. That's $1 billion to the bottom line. They already spent the money making the movie. That's already in their books. So now they're getting back $1 billion dropping to the bottom line. Then they're getting $1 billion in merchandising. That's another 10% of their total revenue. Then they've got another Star Wars movie being released in the winter, not the main sequence, but it's like a story of the rebels who got the plans for the Death Star. That's what it is. So in the winter, there's going to be a side story of Star Wars of the people who got the Death Star plans in the first movie. Just that story of how that happened for this group. And that's Disney's plan. So they're going to have Star Wars movies every single year, and they aren't all going to be mega things, but they're all going to be nice little money makers, and more importantly for Disney, it keeps the merchandising moving. It's all about the merchandising. Now they're opening up a Star Wars theme park, 2 Star Wars theme parks, one in LA and one in Orlando. That's more money and more billions of dollars coming back to Disney. So I like Disney long term. I'm not excited about them because they're getting killed, but I think they're still going to be a good investment to hang on to. What is the bull call spread again? We were looking at the 75-100 bull call spread on Apple, but you can do the you can do the 70-100. You can do the 80-110. I think 100 is very, very safe. I think that's a conservative play. I'm just showing how you can do it for 0. But if you want to spend $5, you can get better spreads or whatever. Our trade of the year was UNG. It actually beat out IBM and it beat out Apple, but it already ticked off a lot. I still like UNG. I still think it's going to go higher, but it's up like more than 10%. It's up 20% from where we started, so it's hard for me to sit there and say I'd call it right now. I wouldn't. I did this trade when Apple was 120, so I'm long a load of 105, 110, 130 spreads. What? Yes, you should. You should always get in a better position. Excuse me. Damn. You should always try to get yourself into a better position if you can. I don't know what dates you're talking about here, but if you're in a 217, I don't get the 130, or I guess you have a whole bunch of different stuff. So the bottom line is, what's your asset? Let's look at it that way. Your asset is your 110 calls. Those are 750. So what I would do with those is I would roll for time, and those are the 110s. So you can go to the 2018 100s for $16.50. So for like not even $10 more, for $9 more. So you say pay $9, and you're going to roll down $10 in strike. Okay? So that buys you another year. So the only reason that would be a bad trade is if you don't think Apple can gain 10% in the year that you're buying. But if they can, then you're better off. You're even better off if they fall because you're going to, you've got more time to recover. So you drop from the 110s to the 100s. You pay $9. You're paying the price of the strikes that you're rolling to. But you're getting a free year of movement. You can leave the short positions, but you say, I don't know, you sell 105, 130. For the 130s, that you sold, I would start off with those, and I would move those up to, they're like $2. I would roll those up to February, not the 105, no, take that back, it's not February, March. Okay, the March 110s. So understand that you have the 2018 100s. If you roll your 2017 short 130s, which are 260 or 270, you roll into the March 110s, which are $2, right? So now these are going to expire in 1 quarter. You have 8 quarters that you can sell. So this way, you start paring down all those higher calls that you sold against. You can start paring them down, and working yourself down to be less and less covered. And if Apple goes lower, then you sell a 118 to cover yourself, if you have to. But hopefully you won't have to, and if it starts going up, you'll be in really good shape. And if it goes up and it goes past 110 here in March, you're just going to roll this to a higher strike. Because as you know, you can obviously already roll it to the 117, you can roll it back to where it was, or you can roll it to something much higher. All right, so in 2018, you can roll those to the 165s, 170s. So there's no harm because you're way down at the hundreds. So you don't care if Apple goes up. You're going to be happy if Apple goes up, even though you did sell the Jan 110 puts. So you understand what I'm saying? I'm saying take a portion of what you've already sold, the highest ones, do a roll, see if you can get those to expire worthless, then do the next one, see if you can get those to expire worthless, and you start building yourself a better position. Oh, you know what? I should have looked to see if, how's our stuff doing? Ooh, gold's popping. That means hopefully my silver trade's doing good. Let's see how we're doing, folks. Oh, yeah, $250. Thank you very much. Come on, man. Who gives you a free seminar and pays you and gives you $250 to take it? Let's get rid of that. There we go. Locked in. $250 profit. That's how it works. It's not a complicated premise, okay? Gold was up, silver was not up. Why wouldn't silver be up? I looked at the dollar and I said, wow, look at the dollar. It wasn't holding 99.50, now it's spiked down. That's why we got that good spike up. And that's it, me, $250 on a single contract, while I wasn't paying attention. Now, if I had done multiple contracts, I would have sold half and seen what happens with the rest, but as it stands, since I had one contract, I made $250 in an hour. That's good money. I like making $250 in an hour. That to me is like a good salary. It's okay. I can get by on that. So what's with the dollar just sliding? Here's a good question. Let's see if Oh, Declan, thanks. Declan said, watch my silver play. I'm like, oh, good. I think I probably saw that subliminally. Thank you. Okay, I probably did catch that out of the corner of my eye and didn't register, but it did make me look at the silver play. So cool. And it says 105 puts, 110. Oh, I see. You sold the 105 puts. I like that. That's great. So roll the 105 puts out to, I highly approve. It's exactly what I said there. You want to roll the 105 puts out to the 2018 whatevers, and whatever's even, do an even roll. Then you take the 110s, roll into the 100s, and you take the 130s, and you roll into the Marches and see what happens. And again, keep in mind, I'm fairly aggressively bullish on Apple here, so that's my attitude about it. So what's with the dollar? I actually, I said that to Nabob in chat. I told him it would get rejected. There's no reason for the dollar to keep being stronger at this point. Nobody's done anything to change anything. And if anything, I would say this sell-off it puts the Fed less on the table. You know, you're going to have less chance of a strong hike. Oh, also the Fed notes came out, right? So whatever the Fed minutes said probably had an effect on the dollar. That's why it spiked down. John says, how to begin incrementally building a short position on Chinese banks? They're already way down, and I don't know any ETFs specifically for the Chinese banks. I don't disagree with the logic, John, but I don't know a good way to play it. It's something I can look at. I don't know if you're a regular PSW member, but if you are, just remind me in chat, and I'll start taking a look and see if I can find anything. But I don't off the top of my head have a good way to do that. Oh, here you go. CHIX is the inverse of Chinese financial, so it seems more focused on FXI. Okay. Taking your word for it, I don't know CHIX. I never play it. Okay, so CHIX. Global X China Financials. So they already have pretty much round tripped back here. I think I was going to short them. I'd really short them after the next stimulus that China announces when they pop back up. They're kind of an in-between place now. Let's see if they have any options. I don't even know if they have options. And if they do, I doubt they're very thickly traded. Oh, they do. Whoa, big wide spread. So they're not active options, and they don't have a lot of strikes. But I will say that, frankly, if you look at these 14 puts for $1.75 or $1.80 in August, that's not a bad price because they're $1.10 in the money. So you're only paying a 70-cent premium for those puts. So you might want to consider something like that. The 16s at 320. Okay, these have almost no premium. So if you can get the 16s for like 340 and then sell these for 120, that's what? That's like 340 minus 120 is 220, right? So that's 220 on the $3 spread. That's in the money. It's 100% of the money. So in other words, all you're betting there is you're betting that your net entry is $13.80. Okay, so you have a dollar cushion. That's if you buy these for $340, the puts, $16 puts, you sell the 13 puts for $120. That nets $220. So effectively, you're short at 16 minus 220, which is $12.80. No, I'm sorry, $13.80. So you're short at $13.80. They're at $12.80. So your break even is $13.80. So all that says is you're betting now that this index will be lower than, all you need to do is be lower than 13, and you're going to collect an 80-cent profit off of 220, which is what, like 40% roughly, in 33%, 35%. So you're going to collect that between now and August. That's not a bad play. And the nice thing about it is you don't need the index to even go down. You just need it not to be higher than it is now. You don't need it to drop 35%. So that's kind of a good way to play it. It's a straight out bet though. You're going to lose if it goes higher. You are betting. It's pretty much a direct bet that you're saying this thing will go down, but it's a nice leverage way to play it where you can turn $2.20 into $3. Which is a very, very good. So you can bet, and again, I would say don't overdo it. You want to just say how much money were you willing to bet and lose on this if you bet it. So let's say you just shorted it, and then I say, well, I don't have to short it at 13. I can just take this spread and risk X amount of dollars. But don't overdo it just because you can with the leverage. NKD 18,000, okay. I don't know I still want to go long on NKD though, it's so ugly, isn't it? These indexes are not holding up very well. Oh, and the dollar's dropping, of course, that hurts the Nikkei. The Nikkei doesn't like it when the dollar drops. So the dollar's dropping because of the Fed. Now we got to look at the Fed and figure out what they said, and I hate that. It's like a whole bunch of work. And my voice is going, so it's hard to say. Let's see. Who's got a good summary of this stuff? Oh, let's just go to the Wall Street Journal or something and let them tell us what happened. WSJ. North Korea bomb test. Okay, minutes. Significant concern about inflation. What are they, insane? Are you kidding? Don't have my password. All right, let me look at my other machine. Hang on a second. The children wrath. He says it, that's what it is. So some scale they got going here with this guy. He somehow has positioned himself as the official communicator for the Fed. Smart though. I mean, the guy's gonna have a job for his entire life. All he has to do is keep in touch and relay the messages. Federal Reserve officials expressed glimmers of trepidation as they decided December policy meeting to raise short-term rates. You can see that. Though the decision was unanimous, some officials expressed concern about. See, here's what you don't find out from the release. You know, when they do the vote, you know the vote was unanimous. But now here's the new information. Some officials expressed concern about lingering low inflation and the effects on the economy. So by being concerned about low inflation, not inflation, this is misleading. They're not concerned about inflation, they're concerned about deflation. So if they're concerned about deflation, that means that they want to weaken the dollar to cause inflation, not the other way around. And it's saying some, not sure how many, because of their significant concern about low readings on actual inflation and the uncertainty and risk present in the inflation outlook, officials agreed to indicate that the Fed would carefully monitor actual and expected progress towards the inflation goal. Some officials said they wanted to see confirmation that inflation was actually rising before they do any more rate increases. Some also said it was a close call as to whether or not they should move in December. That's interesting because it didn't seem like a close call when it was unanimous. So that's what dropped the dollar. We don't have any signs of inflation. The meeting in December was a close call, so you can assume from everything that's happened since that they regret their decision to raise rates in December, and they're not likely to raise them again anytime soon. And in fact, may consider reversal. And that's why the dollar dropped. And that's what I kind of expected, which is why I told Nabob that the dollar would be rejected at 100. All right, these things are not complicated. The thing is, it's just you have to take into account how much people are believing something to make it happen. Now, the question is now, how badly will this hit Nikkei? I still think the 18,000 line is going to hold, so it's not a bad bet still. And you're welcome on the silver. If NG hits 220, would you go long? Oh, absolutely. No question about it. In fact, yeah, that's the line. If you look at the charts here on NG, or maybe there's a better line. Oh, no, this isn't showing me anything. How about stock charts? They usually get to that stuff. Isn't it horrible that I know all this stuff? It's like terrible to actually know every single symbol on every single different platform. Here's NatGas for the dollar sign. So you see, this is what you got to be concerned about. This range is 220 to 260. We're consolidating at 240, trying to break up to that 260 line. But that 260 line is going to get rejected anyway. That's why my target for getting out on mine is 250, but I shouldn't have been greedy. I should have gotten out at 240 because I know it's having trouble. And it's more likely to get back to 220 before it goes to 260. So why shouldn't I have gotten out at 240, get back in at 220 and whatever? But this is what you got. You got a nice solid 50-day moving average. It's shaping itself up. It's going to start curving up. That's a good sign. But you've got to get up here in the near future before this one starts coming down too much. You got very strong signal over here, very, very strong signal over here, very strong signal on the longer term. You've got a very nice signal on the EMA. Every signal here is good and strong, and also the weather's in your favor, the exports are in your favor. There's a million reasons to be long on natural gas right now. I very, very much think we're just basically on our way back to $3. I think we're going to consolidate here for a little bit, but then there's going to be a pop, and we're going to go back to about 3. That's my goal for natural gas. And that's why it's our trade of the year. Thanks for the advice on CHIX, Phil. Wouldn't get into this anyway. Oh, thanks. And Sean says, oh, Fed minutes futures hike was close call. Yeah, okay, so that was what we got out of the closing math. All right, cool. So now that we have to see, now we know more stuff, so let's take another look at what's going on. Here's the dollar. Not really getting dinged too badly, which is going to make the Nikkei happy. Where's my Nikkei? Here it is. So Nikkei is going to hold up here because the dollar's not getting dinged too badly. Oil's holding 34. That's very brave. Gasoline, good bounce off 115. Natural gas, that 225 line looks okay. That's where we went down to yesterday. We were at the low, so we'll see what happens tomorrow. Again, I'm sick of 240 though. If we can't pop 240 by the end of the week, I'm not going to ride it into the weekend at 240. So I am looking to cash out at this point. I'm getting kind of tired of this. You know what? It's not so much that it's not about not having faith. It's that where's my natural gas gone? Oop. Oh, see, the last whole silver went down. NJG 6. I'm trading the April contracts in natural gas because that's my time frame. See, back to 49. It's not that I don't believe it's going to go over 240. It's that I do believe it's stuck in this little channel here, and I could have gotten out here and bought some more here and ridden up, and I'd be making more money than I'm making by watching it go up and down. I'm just sort of wasting time here. So if I want to keep playing it, I should probably get back to day trading it up and down the small channels. You know, just until it pops. Once it's over 250, then that becomes a new floor, and then we wait for it to hit 3. So all good. Here's gold, 1095, seems to be rejected. Nikkei coming back nicely over the 1800 mark, and the dollar is stronger than you'd want off of that Fed minute. So we're still looking pretty strong. Nabal might have his day. We'll see what happens. Oil. The oil report today was horrible. Oh, let's look at that. That's going to be interesting. That's going to be fun. We never do this. What do you call it? The petroleum. Oh, come on. You don't know this? Petroleum status report. There you go. Stupid Google. What could be more important than that? So you see, 10:30 they have the early one. Now it's 1 o'clock. We have the late report, which is a better one with more details. What a catastrophe, though. Where is the thing? Okay, commercial crude inventories decreased by 5 million barrels. But despite the increase, the oil inventories remain near levels not seen this time of year for at least 80 years. It's an 80-year high in storage. Gasoline inventories increased by 10 million barrels. Distillate fuels increased by 6 million barrels. That means nobody actually wants this stuff. They can make it, but no one wants it. Now, what happened? They didn't put more oil in the refinery. See the inputs is 16,595, 16,6, same inputs. The difference is, well, wait a minute, what is the difference? Motor gasoline, I was going to say, look at the product supplied. They supplied less product, see 9.3 and 8.9. They supplied less gasoline. They supplied less fuel oil. They supplied less other products. So this ridiculous bill, they must have been shuffling stuff around all over the place to get the numbers from the last 2 weeks. That's messed up. You guys got to realize how completely screwed up that is, because this is what comes out of the refinery. Less barrels came out of the refinery than last week, yet all of a sudden all these barrels show up. So what I would tell you is that this probably indicates they were playing inventory games, like hiding barrels basically, and now they can't, now into the new year they couldn't hide them anymore. Because there's nothing here to change. The exports are the same, the imports are the same, a little bit less importing, 7.2 versus 7.4. All they've done is move barrels around. So wherever they were hiding 14 million barrels in the last couple of weeks to make it look like that there was more demand than there was, now they had to show them. Because, there's no logical place that they went. Everything here is pretty steady. That's really amazing. I'm really stunned by that. None of these numbers had any particular changes, yet 16 million barrels of product were built up somewhere. Like they came out from somebody's bed or something. It's amazing. It's such a sad scam. It really is. It really is amazing that we can just live in a society where this happens and people can get away with this crap. All right. Anyway, any more questions before I wrap it up? Let's see where we are. We're nice and look, flat is good. When you're down this far, the day isn't flat, obviously, we're down, but we started off the day down and we're flat. And remember, this is the 5% level. So whatever I said this morning about the 5% lines and everything, that still holds. And we're still long off those same positions we talked about this morning. This 16.8 is a good long line over here. 1980, good long line over here. 4,400, good long line over here. 1090, when 1090 crosses on the Russell, good long line over here. 18,000 on the Nikkei, good long line over there. I do like silver over the $14 line. Anytime it's over, I don't mind going long with a very tight stop under 14. So when you close to the 14, you can play it. Now that it's Wednesday, tomorrow you can play natural gas. Not natural gas. Tomorrow you can play gasoline bullish because now it's Wednesday. So I would expect to probably, if you don't mind it coming down to 115, you don't mind buying more. I like the long on gasoline at it's 116.86 right now, or 116.80. So I would pick a long here, but I take a small position, expecting to buy more as it tests 115 again tomorrow. But into the weekend, there's always a chance. And plus, isn't there another holiday coming up, like Martin Luther King Day or something like that? Stock market holidays. No, 2016. Martin Luther King Day is the 18th, so right after expirations is a 3-day weekend. And then we have another one a month later. So that's usually going to be a time when things will pick up a little bit. Not much. It's not a big holiday for anybody, of course. Yeah, today is Wednesday, and but usually what you can count on is that not natural gas. Gasoline usually makes a bottoming move Wednesday or Thursday, and then does a run then usually Thursday or Friday we'll do a little bit of a run-up. So this is very worth taking a chance on going long on gasoline here. In fact, I'll take a long and see what happens. I'll just pick up one and see how it goes. RB. Well, let's see what we get. Wow. Just went down my foot. I'll offer, no. It's really, look at this. Give me a big favor here with my entry. All right, we'll take that one. Oh, it didn't fill, you bastard. There it goes. All right, so we got one at 116,420, and already it's below it. But ideally, I'd like to be in at 115. So really, if it goes back, so since my goal is 115, I'm going to add another one halfway to 115, and I will add two more at 115. So let's see, that's going to be 1157. I would add one, and then I would add a couple more at 115, and that would average me out around probably 1155. So 115.50 is about where I'm going to actually be shooting for to be long on gasoline. Now, let's take a look at a couple of examples on gasoline. Daily? That's not going to be great. Is it hourly? How's hourly? Okay, hourly. So what are... So we have the Wednesday was the 30th and the 23rd. So on the 30th, what happened? Wednesday the 30th, so you bottom out, and then you come back up, and then you bottom out again, same place basically, and then boom, that's Thursday the 23rd. That's a big move. That's 7 cents. That'd be, on gasoline, 7 cents, it's $420 per penny. So 7 cents is like $2,800 or $3,000. What happened the week before that, the 23rd? See, now here's Wednesday the 23rd. We hit the bottom low, and then boom, another gigantic move, a 10-cent move. That's $4,000 per contract. Before the 23rd was the 16th. We bottomed out on Thursday, and then boom, you're getting spoiled now, but this is only a 4-cent move. But a 4-cent move is still pretty good at $1,600 per contract. So this is something that it's almost one of the most short plays we do every week is we go long on gasoline after it has a big spike, after it has a nice move down. And I consider this a nice move down. This is a good enough move down where I'm willing to put my foot down, and even if it drops down to, like I said, to 115, I think we'll be okay. I think we're going to get spiked back higher than that. And as you can see, this is about as low as it's been all year long. So I'm only playing this not because I think overall we should be bullish on gasoline or anything like that, but because I think that the tremendous build of gasoline barrels wasn't because of any supply-demand issue. It was just because they were screwing around with the numbers in the last couple of weeks, and now they had to pay for it. But if that's why gasoline dropped, that's a good reason for me to go long. Because gasoline didn't drop because of any particular lack of demand. And look, these criminals, they knew it. They knew this was going to happen, and they've been selling and selling and selling because they know that they're going to get in trouble when they see this report. Because they lied. This report was a lie, and this report was a lie. They knew that. That's why they sold like crazy. They knew they were going to get caught in their lie. But now that they're caught in their lie, it's bottoming out. Now you can start buying because it's not reflecting a lack of demand. That thing we were just looking at didn't show a lack of demand. They produced the same amount of barrels they always produced. They supplied the same amount of product they always supplied. They can supply more product. And those barrels just appeared out of nowhere. There was no more oil entered the refinery. The same amount of oil went in the refinery. The same amount of barrels went out of the refinery. Yet, there's suddenly more barrels. That's just somebody messing around with the inventory, that's all. All right, so that was easy. So we have a long gasoline now officially. And whoa, what's going on? All right. So like I said, if it goes down to what, because I'm at 1164, I want to be 420 under 116, so that I balance out at 116, right? So I ideally would like to come back in at 1156-ish or something like that. If I get a chance. If I don't get a chance, then what do I care? If it goes up, it's fine. Ooh, look at that. There's gold going up, so silver must be doing okay. And we're going to keep an eye on the dollar. We're going to keep an eye on a lot of other things. I hope my natural gas has come back. That'll be nice. And on the bigger chart, silver is, nope, 1405 again. See? Now gold's going up, silver's back to flat, so you can go long on silver again. I don't have too many things. If you do too many things that are unrelated, you get kind of confused. But I do like silver long. So now we're back in the same place we were before. Ding. Because if gold's coming up here, gold's only pausing because it's hitting the highs. It should make a nice run. So I think we'll get a nice spike in silver there. Make another few $100 before the end of the day. I'll be very happy. All right, so we will be back next week, and we'll see how these two trades work themselves out. This one's already down $138 because gas is so dangerous. But we'll see what happens, okay? And this guy's at 47,420. That's another exciting thing we'll find out about next week, how that trade went. But you know what? This is the last webinar. Let me tell you something, guys. The last webinar, this thing was minus $13,000 or something like that. So it's up $60,000 from the last webinar. This is a trade we discussed 3 weeks ago. I still like it. I don't like. I mean, it's not as good of a trade as it was when it was way down where it was, but it's still a good trade for long. And we'll see how that comes out. But I mean, over the next few months, I do expect this to be well over 250. And 250, even if it's only 15 cents up from here, that's still $50 a penny is $750 per contract. That's still a nice little move. All right, so thanks everybody for coming, and we shall do it again next week. All right, thank you. Well, futures webinars be held Tuesday. No, usually they're Tuesdays at 1 p.m. We had a technical thing. Last webinar we did, we had a technical thing. I was on vacation. Greg came over yesterday, and we decided to wait a day to make sure everything was working correctly. And here we are. We went through the whole webinar without a technical difficulty. So thanks to Greg for doing that and fixing the computer. And hopefully we won't have any further issues. All right? But that's why we moved to Wednesday, though. It was just because I had just gotten back from my vacation, and we wanted to make absolutely sure this thing went off without having problems. But it's working correctly. Our normal time is Tuesdays, 1 p.m. All right? Thanks a lot, guys. Have a great day.